Well, hindsight may well be a perfect science, but 10 years ago, a 500,000 Rand investment or 10,000 Rand investment rather, in 5 shares is today worth in excess of 6.5 million Rand. In his cover story this week, Bruce Whitfield went back in time to discover which were the best performers over the last decade, and then asked some experts to gaze into their crystal ball to identify what could be the next winners over the next decade. So joining me for this discussion, as I was saying, Mark Ashton, Finweek editor, Bruce Whitfield, Adrian Saville, CIO of Cannon Asset Managers, and Wayne McCurry, head of Momentum Wealth Portfolio Management. Thanks for joining us, gentlemen. And of course, I'm outnumbered here on Women's Day. So Mark, you know, the past doesn't necessarily tell you what's going to happen in the future, but it is fun to see how much money you could have made if you picked the right horses.
For sure. I think this whole story basically started as a bit of an ego thing. So Bruce asked me what share in the last decade's done 25,000%. And of course, he didn't think I'd actually know the answer to it. But I got it right, and Bruce had to then go and decide he was going to write a cover story on this. And I think, you know, in your intro, you looked at it and you said 50,000 Rand investment today was 6.7 million Rand. And for me, that would be the reason I would want to get into the stock market, this idea that there is some way to be able to generate some real wealth over a decade. I mean, you know, 10 grand investment is doable for any man in the street. 10 years, believable time frame. I think that that's cool. There's just something really invigorating and interesting, and I think that kind of is the allure of the stock market in general, is that you do have opportunities like this. They do present themselves. It's just a case of looking through seeing what options are out there.
Okay, so we have to explain which were the winning stocks. Tell us about that, Bruce.
We most certainly do, and what's so interesting about these, other than Mr. Know-it-all over here, who happens to think he knows the answer to everything, when I said to him, so which was the best performing stock over the last 10 years, he'd been tipped off that it was Pinnacle Technologies. 10 years ago, you would never have dreamed of investing proper money into a company worth 15 million Rand on the JSE with an office somewhere in Pretoria. Are you completely nuts? But that's what's so interesting about this. And Adrian Saville, of course, is a big fan of the small companies, and he'll explain why in just a second. But Pinnacle Technology, PSG was run by this guy who'd been fired by his own stock brokerage just a couple of years before this, Yanni Mouton. Plus, we've got a small banks crisis which we've just come out of. Remember that.
You're going to back someone who doesn't have a great track record. Of course, you have to buy into his whole vision.
Absolutely, and that's quite high risk. So would you really back Yanni Mouton 10 years ago? Well, clever people did. Capitec, that was coming out of the PSG stable as well. Howden Africa, what's that? African Media Entertainment, please. It owns Radio Algoa and OFM in the Free State. Are you completely bonkers? But maybe that's the secret to really superlative stock picking, is not looking at the now, but looking at what the potential is into the future. And that's why people like Adrian Saville, Dr. Adrian Saville, who look at valuations of small companies and say, hold on a second, is there the next Microsoft hidden somewhere amongst this mess of small companies that look messy today but could be gems in the future?
But how do you know, Adrian, Dr. Adrian Saville, as Bruce likes to refer to you as, how do you know that you're not going to bet on a stock that, of course, is a small cap and could go bust?
Yeah, Samantha, I think that's the key is, you know, how do you know? There's always going to be something hidden around a corner, especially where you're working with smaller businesses well off the radar. And to my mind, that's why it is pivotal that you have a portfolio here rather than a single name. And the portfolio affords you the opportunity to get some things wrong. You will get some things wrong. And if you're venturing out to say, I'm going to get absolutely nothing wrong here, I think that's probably dangerous turf. That's a fool's errand.
Yeah, I mean, just looking back at the environment, you talked about the environment 10 years ago. It was post the tech bubble, 9/11 had happened, start of the credit bubble, and of course the recession was something people weren't, of course, predicting. So how does that operating environment shape the investment decisions, or does it, should it?
But Wayne's also better positioned than me to talk about this, because here you've got a position, 2003, it's before Alan Greenspan. Well, Alan Greenspan was beginning to get completely crazy with low interest rates. It was before the huge credit boom that we saw around the world. That was in its early stages. Now, if you can read the tea leaves properly, then you can accurately forecast who's going to do well into the future. But if you take your mind back to 2003, where the world was a much scarier place than it was today, this person bin Laden that America was hunting in the Middle East, the gold price wasn't doing particularly much, the oil price wasn't doing particularly much at that point, and suddenly the world over the subsequent 10 years changed. I don't know if it's possible to be able to forecast today what is going to be great in 10 years' time, because There are so many uncertainties. We have no idea what lies around the corner.
No, you can't, Bruce. I mean, you are right. You can't actually forecast what's going to happen in 10 years' time, but you can say a couple of things with reasonable degree of certainty. Is that capitalism will probably still be here.
Okay,
Probably.
that's one.
Yeah, okay. Companies that have been around for 30 years will probably still be around in 10 years' time because they've faced all the challenges, they've done all the things, they've gone through the ups and the downs. So that's probably a reasonable statement to make.
You're picking companies that have a long-term track
I'm taking
record.
big companies, yeah. Small companies, I mean, there are some total gems there, but you know, if you take any rolling 10-year period on small caps, your attrition rate is massive. It doesn't mean the companies go bankrupt, but let's just say underperform by 50% or underperform cash. So there are some gems, but that is small caps. You know, small caps, if 2 out of your 10 or 1 out of your 10 works, it normally works so well that it makes up for the other 9 that don't work. But it takes a different kind of investor to sit through that, because sometimes it's painful.
Absolutely.
Yeah, I mean, I think one thing's, Wayne, that we've got a very concentrated, very small, very liquid small cap sector. I mean, one of the things, you know, RMB came out with their small cap, mid cap ETF last year. I mean, a really cool product. It's something that we don't have. Yes, we've got a couple of unit trusts that kind of trade in that space. We've got some nice value managers who do kind of see through the cycle. But for retail investors, it's a very nice accessible point. And I think that if you look, if you kind of back test a product like that, you can see that there is value in kind of buying into a low cost.
But you know, as Adrian said, you've got to build a portfolio.
Okay.
You know, don't hear what someone said on TV or what someone told you in the school car park that this share's a winner,
or what somebody
wrote in
Finweek
and say this and just take one. Don't ever do that, because you might be right.
Let me test you on this one quickly, if I may. Do you mind if I do?
Go ahead.
Would you add anything to your portfolio, any one of these? Santova, Conduit Capital, Zeda Investments, Pan-African Resources, or One Logics? Those are Adrian Saville's picks.
No, I know that, yeah. Zeda's fine, Pan-Af is fine.
Okay.
I've got no problem with the others, quite frankly, I don't know enough about, because I don't analyse small caps really.
Okay. So
But your top picks, let's get into those, and then Adrian can explain the rationale behind the smaller companies he's backing. Tell us about those.
It's very, very standard, built around essentially one, maybe 2 themes. The one theme clearly is China is the only economy in the world that has the ability to grow. The rest of the world's economies are overladen with debt and will show subpar growth for the next 10 years.
That's, of course, if you're looking at the developed world.
Yeah,
What about
but I
other
mean,
emerging markets?
But other
Of course, not
emerging
on that
markets,
scale.
where's the capitalization? Where's the history? What do you know? It's very, very risky to go into other capitalization markets. So sticking to SA shares, and I mean China will always be the big engine of developing market growth. Going for Richemont, quite clear China theme. Going for Billiton, quite clear China theme. Sasol, a little bit different. I like the gas story in North America. I think this will be the world's source of energy in 10 years' time, and Sasol's ideally placed for that. Vodacom, you know, despite MTN's results, I still think the cell phone market in South Africa's got the ability to generate extremely good dividends, very, very stable business, sticking with that. And then the last one, sitting with Bidvest. I mean, I don't suppose anyone can add much more to Bidvest. Why not?
I mean,
absolutely.
just looking at these stocks, Adrian, do you think that they have the ability to shoot the lights out in the same way that perhaps some of the stocks you've chosen have?
The stocks that I've chosen probably have the opportunity to dig through the floorboard as much as they have the prospect of shooting the lights out. Wayne has proposed here, I think, some really sensible investments, and there's a lot of what he ventures that I like. Vodacom, for instance, for its data. This is a gold mine. Sasol, I agree absolutely, you know, with the energy prospect. But these are not going to do 100 times or 200 times your money, and I don't think that that's what Wayne is venturing or volunteering. These are great businesses, well run, good balance sheets. They've got powerful drivers behind them. They'll do well as an aggregate. What I volunteered is something entirely different. What I volunteered are companies that have the prospect to really alter the landscape within which they operate.
So Santova, tell us about that one. Not a name we talk about a lot.
No, Santova is going to be off almost every South African investor's radar. It has to be, just by virtue of its size. This is a 150 million rand market cap. I think run by a respected, regarded executive team headed by Glenn Gerber. The net current assets of the company make up half of its market cap. It's been profitable every year since it was listed, which is 10 years ago, and it operates in the trade logistics area, which if the world economy is going to move ahead, admittedly with some difficulty, trade and clearing and logistics are going to do this at some multiple of that. So I really like this from that structural perspective.
What do you look at when you look at one of these companies? I mean, yeah, okay, we've got Santova there. You've touched on management. Do you look at what management ownership in terms of the business? Are they regularly buying shares, debt versus cash? How do you actually assess something like that? I mean, you can get an idea of a strategy for a company like Sasol because they give you an annual report year big and they'll tell you what their plans are for the next 10 years. But looking at a smaller business like that, I mean, you're putting a lot of trust in a relatively small group of people. And the levers are very, it becomes a highly leveraged business in terms of a deal comes off, then it materially changes the business.
Yeah, I think all of those are vulnerabilities. They face very high management risk. They are generally narrow businesses rather than broad businesses, and that leaves them vulnerable to getting just one thing wrong, and the entire business could disappear, as Wayne points out. This is why the attrition rate is so high. For that reason, I think you have to do a lot of work on understanding not just the business, but the caliber of the management, the strength of the balance sheet, the nature of the industry that it operates in. And whilst they are more vulnerable, I think they also are easier to understand. And these are businesses that are much easier to figure out. It's not 47 divisions. It's not 5
47
geographies.
pages of annual results that you have to delve through and pick through
these
the
are
numbers.
neat businesses. I can explain these to
Me.
to Bruce.
Exactly.
Bruce
He can explain them to me. I mean, I venture to suggest, Sam, that if you went to pages 16 and 17 of this week's Fin Week and you took a proportion of your money and you put a percentage into each one of the shares that Wayne has chosen and what Adrian has chosen, you've got stability in what Wayne is offering over the next 10 years and a little bit of excitement and adventure in what Adrian is offering over the next 10 years. And the proportion of your risk that you're prepared to put into Adrian's shares determines whether or not you double your money over the next 10 years or whether you do considerably better than that. The risk and excitement sits in what Adrian is talking about. What Wayne is talking about is good stability and good solid
returns.
Yeah.
The thing is, I mean, just looking at, for example, you mentioned ShopRite versus Pick n Pay in the article. I mean, ShopRite's returns over this period was 3,215% versus Pick n Pay 458%. What if one of the stocks that are kind of the well-known stocks within the David Shapiro's picks in the article, Wayne McCurry, your picks, what if those are the Pick n Pays? You know what I mean?
Oh, it could easily be, yeah.
Easily.
But again, you haven't lost money on Pick n Pay. You still made a return of, what was it, 350?
Almost 400, almost 500%.
Which is not fantastic, but you've not lost money. In every portfolio, every unit trust manager, every single asset manager, every single individual who's ever gone and constructed a portfolio of shares, you have some that do well and some that do less well. When you would have bought in this fictitious portfolio Pick n Pay 10 years ago, Sean Summers was running the place, Raymond Ackerman, the legend of retail, was still very much there and driving the business. Why would you support a lunatic like Whitey Basson who wants to go into emerging markets? I mean, you had to be particularly courageous to choose ShopRite 10 years ago over Pick n Pay. But isn't that the moral of the story? That true, real investment returns require some courage, and courage of being able to say, I believe this is the way in which the world is going to evolve into the future. I'm going to support ShopRite over Pick n Pay. If you had that foresight, you did better than the person who was more conservative and went for Pick n Pay over ShopRite. You didn't lose money on Pick n Pay. It's not a disaster, but boy, you regret not buying ShopRite.
Yeah.
And that's the point of this article, is fortitude, courage, and foresight are probably very strong characteristics in outperforming the average on a market.
But, Wayne...
You're taking more risk on it, yeah.
For sure.
Yeah.
Yeah.
I mean, I actually, surprisingly enough, thought long and hard and did a bit of work as to which shares I selected for you there, Bruce.
Thanks very much.
Okay, that's a pleasure. And I mean, other ones that I thought of, I think the platinum shares in the 10-year basis are very good investments, but it's too risky. You might be wrong, Why not choose a company like Rainbow? It's changing its spot, so to speak. It's evolving. It's going into food corp. What about Grinnrod?
Yeah.
You know, there are still other shares to choose, but you just don't know. And, you know, maybe let's call us the institutional managers, Shapiro, myself, maybe institutional managers almost haven't got that mindset, because, you know, if we are to take a client's pension fund, and even if we invest 1% of the pension fund in a company, that just disappears.
Yeah.
You know, you quite frankly are in deep trouble. Even if you picked another 5 that were very successful, you actually can't, you're almost conditioned not to take that type of risk on it. And that's why the large institutional managers choose all the Bulletins and the BATs and the Rembrandts and the SABs. You can still do well, you can still beat inflation, but you're never going to pick the winner.
What about, just to pick up on the platinum side of things, I mean, Stuart Cantor picked up on one of the platinum stocks. Amplats is one of his top picks for the next decade. How do you feel about that, Adrian, as a value investor, kind of looking in that deep value space?
If I could stay away from Amplats just for a moment, I'm happy to come back to it. But the observation I'd make about Bruce's results is there are 2 attributes of these superstar investments. The first is they were unloved at the time that they went into his portfolio. 10 years ago, this was a banking crisis. A cavalier chap sets out a financial services business, a 15 million rand market cap technology company. Every single one of them is unloved at the time that they go into the portfolio. Second, they are small. It's impossible to grow the world's food supply in a pot plant. You're going to need to start looking at smaller prospects if you want to achieve super results, notwithstanding Wayne's observations and the importance of doing your homework. It's not just about, well, I'm going to close my eyes and buy small unloved stuff. You have to do your homework here. And if the platinum sector, to come back to your questions, Sam, if the platinum sector is unloved right now, I'm interested.
Okay, now Pan-African Resources is an interesting one, because you sent this through a couple of days before the chief executive quit. I did. Does it change? However, the chief executive quits. Suddenly, Jan Nelson is no longer there. Does that then, with the benefit of hindsight, do you remove Pan-African Resources? Because suddenly that element of certainty upon which you based this pick is no longer there.
Yeah, so when the facts change, I think you have to be willing to change your mind. What's important to change your mind. The management team at Pan Africa is much more than just the CEO, and they have an aggregate experience in operating all of the assets, including in particular Evander.
Which underlines the point, which underlines the point, of course, of understanding the business and knowing that if one person does go, it's not a disaster.
Agreed.
Yeah, there we go. Point I was trying to make.
Sorry. Back on my box.
What are you going to say?
I was going to say, we haven't put Bruce on the spot yet to fund another 25,000% for the
We
next
need Bruce's 5 shares so we can reevaluate him in 10 years' time.
See, the marvellous thing is I have a lunch appointment and I have to go. But here we sit, Adrian, with these 5 shares. This is called passing the buck. Which one of your 5 shares of Santova, Conduit, Zeda, Pan-African and OneLogics, which is the next pinnacle technology?
The pinnacle technology I would venture is either OneLogics or Conduit Capital.
You got to choose one.
You're still not going to let me have a portfolio, not even of 2?
No, just one stock.
One Conduit Capital.
Okay, and from you, Wayne? One stock for the next decade.
Out of my 5, I think I'll pick Sasol, in fact.
There we go. We'll leave it at that.
Excellent.
Thank
I'm glad
you
you
all for
didn't
coming
come,
in.
because I'm a journalist and I've got to be objective. I couldn't possibly.
And you've got to get to lunch.
And I've got to get to
So
lunch.
we'll leave it at that. Take a quick break. No, well, before we go to break, one stock.
One stock.
Just for fun.
I couldn't possibly.
Okay, fine. Well, that's